Um, so Joseph, are you able to add people as they come
Yeah.
in? Okay, cool. So I'll let you take over that for now. So my last time kind of saying this, because I think we're officially starting now. I asked my friend Joseph here up in Mammoth Lakes, he's an agent, to help moderate this. In the past, when I've done these things, I like it now that I can actually see people's faces and get reactions, because in the past I'm just like staring at a screen talking, and I think it's more boring for me than you guys, and probably really boring for you guys. This whole kind of conversation came up because Christine and I just finished redoing our fourth or our line of credit for the fourth time. I think one of the reasons why I got so much traction on Twitter is people thought I had four HELOCs on the same property or four HELOCs on other people's properties, and there was some level of fraud. Um, to my knowledge, there's no fraud in this transaction. It's replacing the fourth HELOC, but we've used our HELOC in the past to really kind of grow everything. So Joseph, actually, when I hand off to you, you can introduce yourself, and then we can get started. And I'm going to share my screen.
Cool. Yeah, real quick, my name's Joseph. I'm here just to moderate. I'm a real estate agent in Mammoth Lake. So hit me up when you're here to ski. And I just want to introduce my friend Daniel Morgan here. He's a broker at Marterra Real Estate, owns a property management company, and is a fund manager that focuses mainly on fix and flips. So we're here to learn about HELOCs and how we can implement them, whether we have a home or even just know someone who has a home. Quick example, I was talking to Daniel about this, and I thought a HELOC would be a great idea to convert a one-car garage in my mother-in-law's house in Westchester into an ADU, right? It's a very popular thing going on right now. And so we're like, so Daniel kind of estimated maybe 200K for the remodel, for the conversion, and then she could easily get $2,000 a month. So that's a pretty good return depending on your interest rate. So we're here to learn about that stuff. Start thinking like this as we go through and put your questions in the chat. We'll get them answered.
Yeah. So the first thing I'm going to tell you is nothing. Wait, can you all see the screen?
No.
Oh, that's here. Okay. Can you see the screen?
Yes.
All right. So the first thing I'm going to tell you guys is that there's nothing that I'm going to tell you today that is complicated. I don't think complex. Honestly, that smart. It's just the type of thing that once you hear it, you're like, why didn't I think of that? Or why aren't I doing that? So if at any point during this you're like, this is a total waste of time, either raise your hand and tell me this is dumb, or you can sign off. I'm not going to be offended. So our fix and flip fund, that's newer. We haven't always been into fix and flip. We've mostly been multifamily before that. But really, we are focusing on fix and flip right now because that's where we think we're seeing the easiest money to be made in our market. So I'm going to start with some really kind of basic stuff, like what is a HELOC? Elliot or Ryan, if I mess anything up, I'm going to defer to you guys on it, and you can raise your hand and correct me. I have no pride whatsoever, so just go ahead and correct me if I'm wrong. But essentially, a HELOC is uh, a line of credit, kind of like a credit card that you get on your house, assuming that you have equity in it. Um, and generally you need at least like a bank will lend at most kind of up to 80%. There's probably some pretty wild groups out there that may do more than that. When you take out the home equity line of credit, you don't get a check all at once, and the good thing about that is you don't start paying interest. Like a credit card, you can kind of pull the funds down as you need it. The other kind of common feature that I really like about lines of credit is, well, also like a credit card, it has a what's called a recasting feature. So if you have $1 million balance, they're going to calculate each month your interest payment off of your outstanding balance. So let's say you have a minimum payment of like $3,500 for interest. If you pay 4,000, your balance goes down 500. They recalculate your interest payment off of that. That allows you every month, as you hopefully pay this down faster, to continue to see your payment to come down and create kind of a snowballing effect. This last one, I'm not a CPA. Please consult with your uh, appropriate state's licensed CPA, but you very well may be able to deduct, I occasionally do, your interest on your line of credit. There are state and local income tax limits and other um, rules that relate to what you're using your line of credit for.
Daniel,
Yeah,
can you use a HELOC on a rental property that's not owner occupied?
you can. Not every bank will do it. Elliot or Ryan, do you guys have any programs that you're aware of for second properties?
You can definitely do it on an investment property. It's going to be typically an overall lower loan to value. So, maybe capping out at 75% as opposed to 80% is pretty standard. We can even do 90% on a primary, but you can definitely get it on an investment property.
And sometimes the rate's a little higher too. Ryan, did you have something?
No, no, I was gonna say I defer to Elliot on that. The bank doesn't do anything as far as investment properties, so that's gonna be a broker product for sure.
So there are some banks I know that do it, or I will say have done it. First Republic used to do it. They're no longer with us. Um, really miss them. But we have found First Republic 2.0. If you have questions on that, happy to connect you. Okay. I can't go any further in this presentation or discussion without talking about the risks. When Christine and I first got our line of credit, she said, "Isn't this how people lost their house? And if you buy jet skis or non-income producing assets, you are very much at risk of losing your home. Do not over leverage." I'm going to say things later on in this conversation that sound like we over leverage. We do on individual properties, but on an overall portfolio basis, we're very low leverage. One of the concepts I'll encourage you to think about is uh, try, especially as you're starting out with your line of credit, to pair. Josh, that's a great question. Josh just asked, who says jet skis aren't assets? And that's a very good question. I'll have to defer to someone smarter than me on that. That's just what I've been told. But when you first start out with your line of credit, you want to pair your liabilities with your debt obligation and hopefully get them pretty much to match up. So if you have a $2,500 a month payment, it would be great to have at least $2,500, ideally more, in income to offset that. The higher your earning potential or your earnings, the higher you can take on more risk if you're kind of depending on where you're at. But please be very, very careful and mindful of the risks. The interest rate can go up. 2021 was not a fun time to have a line of credit. I had a lot of money out on my line of credit on a development project, which is something I would never tell anyone to do, especially in a rising interest rate environment. We survived. It was okay, but there are definitely risks associated with a line of credit. This is the kind of one of the most important things I think to think about, and this is like evaluating home equity lines of credit options. Every single lender is wildly different. I don't think my buddy Zach Brown is on here. Let me just check. I should have said his name. I should just talked about it, but now I outed him. But years ago, I told Zach, "Hey, go get a line at Bank of America, and we'll go do XYZ deal together." He went to Wells Fargo because all big banks are created equally. His line of credit was prime plus one. Mine was prime minus 150. So that was a 2.5% spread between our interest rates. It's a lot harder to do deals when your interest rate is 2.5 points higher. I'm going to skip ahead to the next slide and then come back to this one. And I want to talk really quickly about how HELOC interest rates are set. So I really love that there's two mortgage lenders on here who are going to be laugh at me if I get anything wrong. But traditionally, when you get a new loan, it's priced off of the 10-year treasury yield. So today, the 10-year treasury is somewhere around 4.3 or 4.4. I haven't checked this morning. I don't know. Things are wild. So maybe it's off from there. And there's some sort of spread over that. So you only see rates drop when the 10-year treasury drops. Well, the HELOCs are priced off of what's called the prime rate. Prime rate's typically 3 percentage points higher than the federal funds rate. So when the Federal Reserve increases rates or cut rates, your rate will go up or down lockstep. So when people talk about it, it's prime plus or prime minus. So that's just how the interest rates are kind of set. What you want to also look at though is interest rate structure, because there are loans. Someone on Twitter was talking about getting a $700,000 line of credit at Westcom with a teaser rate of 3.99%. That's a really good introductory rate. I'm not opposed to introductory rates in this instance. Just make sure that the post introductory rate it isn't going to get you in trouble. So the loans can be fixed rate, they can be floating for some period of time, they can go interest only, and uh, or fully amortizing. For me, I prefer interest only. I want to amortize it as quickly as possible, but interest only gives me the option to do that at my own pace. Once your drawdown period ends, either there's a balloon payment or there's a repayment period. You want to understand all of that stuff before you open up your line of credit. The second most, in my mind, important thing to evaluate is capacity and proceeds. And by that I mean my first line of credit was 100,000. My second one was 330. The one I just closed is 1.2 million. So obviously, a higher capacity is going to give you more optionality of types of projects that you can do. But sometimes the higher capacity or proceeds means a higher interest rate. So depending on where you're at and what you're trying to accomplish, those are sometimes competing interests, and sometimes they're not. I've seen some banks that charge a higher interest rate on loans above 500, and some that charge lower interest rates below 500. So those are things that you want to understand. Talked to a gentleman this morning, and this on fees. So a lot of banks have no fees or no maintenance fees. Some are $90 a year. One guy, he was telling me it was like $4,000 to get the line of credit. You want to understand that before you go into it. Most of them, again, are no fee. Some of them have an early closure fee. So Bank of America, for the longest time, it was like 450 or 350 if you closed your line within 3.5 years. It's not that big of a deal because there's no upfront expenses. The last item to take a look at, drop period and repayment terms, which I kind of hit on above. Anyone
Yeah,
have
no,
any
if,
questions? Yeah.
Dominic's current interest rate is 10.6% with a 13K balance, can he get into a lower rate?
I am convinced that anyone on this call with a MNLO license can get you a lower rate, even people who don't think their rates are very good. Is that on a primary or on an investment property?
Doesn't say. Let us know, Dominic, whenever you're ready.
But yeah, you can absolutely get a lower rate than that. Again, this is why. So I would look at potentially closing that out and getting a HELOC on your primary residence. Generally, you get the best rate in terms on your primary, but you should be able to fairly easily get somewhere around prime, plus or minus a little bit, depending on what you want in proceeds.
And Dominic did say it was
Yeah.
his primary at the time and now an investment income generating property.
So this part, if anyone has anything that they're thinking about doing, I'm going to walk through a few different like examples of things that we've done that are kind of different types of programs to give you guys some food for thought on different strategies that you can implement. If anyone's looking at doing something else and they want to just throw it out there, we can talk about it. I think the group will benefit from it. So the first line of credit I ever got was $100,000. I swear Bank of America at least used to have the best line of credit program, or one of the best lines of credit program in the country. Great place to start, especially if you work there or bank there. In terms of looking for banks to bank at, I strongly recommend start with credit unions and wherever you bank. Also, the rates generally aren't necessarily very straightforward, so you need to ask about discounts. A lot of banks will have programs where if you draw down $10,000, they'll give you 10 basis points off your interest rate for every dollar that you draw down. That's not necessarily advertised, but you have to ask about it. Or for minimum deposits or for auto pay. So you need to ask a couple follow-up questions to make sure you're getting the best rate. So on the $100,000, so my first multifamily deal that I bought was a 6-plex in Costa Mesa. It took me 2 years to figure out how to raise money. And one of the most important things that I've learned is access to capital is the fastest way to get involved and make money in real estate investing. All we're trying to do here is encourage you to maximize your access to capital. So on that one, I got together some LPs and we bought a sixplex in Costa Mesa. My equity investment was funded by my line of credit. And funny enough, I actually forgot about this until we were putting together the slides. And the LP money actually came from one of my clients who owned uh, a debt-free home in Newport Coast. So we helped him get a line of credit on it. We used that line of credit as a bridge loan so that we could maximize our equity in the deal. I personally guaranteed that. And that, so kind of two things there. One, like a co-investment in a larger deal if you have a smaller amount. Two, this is kind of a really important point. If you have friends or family that have equity in their homes, they should also get lines of credit because that can become your access to capital. I've also done which like for past flips, if I needed money, I would, if some of the interest rate was at 3% on the line of credit, I could borrow from them at 8. Did that with my brother a couple times. He made like 40, 50 grand per deal, and that's just manufactured spread. So you can be on either end of that as the lender or borrowing money from people. I think one of the most straightforward paths to like using it, that's kind of the simplest, is our second time we increased our line of credit to $330,000. I bought a little 2-bedroom condo in Orange back when you could buy them for 330, and we renovated it and rented it out. Every time the tenant paid rent, paid down the line of credit. Every time we made an extra buck from anything, we paid down the line of credit. We're really disciplined about it and ended up paying it off pretty quickly. You can take your line of credit and pair that with additional funds to give you essentially a lower interest burden per, like, as a percentage of your rental rate, which is probably a very smart thing to do in this economy, because you do see, interest rates are pretty high, and so it'll probably be pretty hard to buy something 100% financing and have it break even. So I don't know, Elliot or Ryan, have you guys dealt with borrowing against 403B accounts?
I never have now.
I've had, clients borrow against a 401k. It just kind of, or, 403b, but it's going to depend on the terms, really. It's like really specific to, the account that you have.
Yeah. I do know that, and I don't know if this is specifically a 403B, but asset-backed lending um, is generally even better priced than HELOCs. At the bottom of the interest rate cycle, I thought I was really like doing really well with a 2.15% interest rate on my HELOC. But one of my friend's dads told me that he was borrowing at 0.5%. So I'm a poor real estate guy. I never have any money in my bank to borrow against. Uh, Maybe one day, but that's a whole nother program that I do recommend that you look into. Again, you should be evaluating that against uh, your HELOC options, but also if you can do both, do both. There is no, as long, I'm not saying do both and like spend all the money for both, but like having as much access to capital is never a bad thing. Um, and then as we redid our line of credit, it was previously at 980, now it's at 1.2. In that we would generally partner with one of our friends who also had a line of credit and go offer all cash on homes to go flip them. And if we're borrowing at 5 or 7%, and we're making 15 to 20% on a flip, overall it's a pretty good spread. Yeah, so Schwab's good at that. Private banks with wealth management. I'm pretty sure U.S. Bank has a pretty good program for that as well, about the asset-backed lending. But wherever you bank, that's a great place to start. Along with Schwab, definitely does that as well. Other uses that you can use for a line of credit that may or is the lending kind of programs that we talked about, home renovations or additions. You can argue whether or not that's an investment, whether or not that's a good investment, depends on your market. But again, my whole goal here is trying to get you to get more access to capital. Oh, and then the last thing you can do, and this is not the last thing, but one of the other things that we've done is if you go if you're approved for your line of credit and you go get a loan from a bank, the bank will underwrite you assuming your line of credit. So you can use your line of credit oftentimes as the down payment along with a loan. That's the stuff I was referring to before when I said that like you're going to end up with thinking that we have like a lot of leverage in a lot of deals. So if you end up, so if you go with like a 60% permanent loan and you put in 40% from your line of credit, my goal would be to pay off the line of credit as quickly as possible. You're not going to be able to do it just through cash flow, but it just does give you an opportunity to have more options of different things to do. Yeah.
And then would you use a HELOC over a construction loan for ADU builds? Elliot says construction loans are typically have a higher interest rate than HELOCs.
That's typically true. The other thing, so there are some really good construction loan programs out there. First Republic, God, I miss them. I still have a couple like sub 4% construction loans with them. There are a couple banks that have construction loans in the high fives, low sixes. There's some additional fees associated with it. But one of the challenges with a construction loan to get really good pricing, you generally have to have your plans and permits in place. And so there's another metric that I like to look at when I'm looking at deals and financing, and that's return on headache and return on heartache. And a construction loan, like the two lenders are the only people that look like they're really laughing at that because they get it. Like construction loans, that's not an easy process. You do the line of credit, you can move incredibly fast. So, you know, the deals that we did where we got construction loans, we had to somehow finagle our sellers to give us like really long escrows. Thankfully, they were during like the very start of COVID and everyone thought the world was falling apart. But it's easier to get a deal done. So if you own the property, you can evaluate a construction loan. If you're trying to buy it, it's really, really hard to buy a property with a construction loan. There are programs for that, but again, they're oftentimes more expensive. So, but that's a great question.
Daniel, and earlier in the conversation, you said there's a First Republic 2.0. Who is
Yeah.
that now?
That is Citizens Private Bank. They that's actually Christopher Moore brought per usual. He's one of the smartest guys that I know. For anyone in Costa Mesa, he's building the Salty Horse right off Cecil. Go check it out. They should be open in August. It's one of the coolest projects that I've seen. It's a full restoration of a I don't know if historic's the right word, but it's old and it's a barn. But anyways, most smaller contractors have a really hard time dealing with the servicing on construction loans. You have to do loan draws, you have to deal with fund control. I have like some pretty good contractors, and it's just so much brain damage associated with the loan draw process. If you're doing smaller deals, like I would pay more money I would pay more money to use a line of credit just because it's easier, not like necessarily a ton more money, but there's apps like you can go faster with a line of credit and you're going to save yourself a lot of heartache. So, but yeah, if you guys get a chance, do go check out Salty Horse. They should be opening in August, maybe September. So we flew through most of what we wanted to get through. This is just supposed to be kind of like an introductory, like primer to get people thinking about lines of credit. Kind of the conclusion is it's a great tool that you can use to fund your properties or business, match your debt up with revenue, hopefully recurring revenue. As you start out, the recurring revenue thing is really important. As you get further in your process, I've got a portfolio of properties now that pays me enough that I can have my line of credit fully extended and I'll pay for it. So I'm more comfortable going a little bit further down the the risk spectrum. Um, but when we first started out and we did a little $100,000 investment, I remember Christine, my wife, making a joke like, "This is stupid. Why are we even doing this? It's not going to change our lives." And fast forward, we've redone the line of credit now 4 times, but we've probably recycled it 8 times, meaning like fully extended it, bought something fully. So it's really has been a huge tool that's allowed us to compound over the last 11 years that we've been doing this. Um, so with that, does anyone have any questions, comments, concerns, criticisms? Too fat for video. Anything else?
So basically what you said in your conclusion, right, is just find a good rate and find a good deal is basically what you're saying, right?
Yeah, it's pretty simple. Start out getting the loan, just even having it is worthwhile. You don't need to have it and then feel the need to use it, but it's just the access to capital that the other thing that's worth mentioning is so we raised this fund and we went from never being able to find deals to deals are coming to us because people know that we have money. The more people know that you have funds, money is a magnet for deals. People will start calling you. And then go get your friends to go get them too, and you can partner up and go do some fun things and make some money with friends and family.
And maybe a little off topic, but where are you finding your deals right now? Like people are calling you. What do those properties look like?
Right now, we're focused on fix and flip just because that's what our fund is mostly focused on. Today, went under contract on. It's not a fix and flip. We're going to tear down the house and build a new one in East Costa Mesa. Um, we actually had it listed for a while, and the seller wanted someone to buy it with no contingencies. Was willing to give up a couple $100,000 for that, and so we just did our due diligence before we wrote our offer. We've got one in. This is an interesting one. We've got one in Newport. We're trying to buy. And because we have the funds to buy it cash, the seller is trying to offer cash on another property. So we're able to give the seller a letter that says, "Hey, we'll buy their property for you, or we're basically gonna buy their property for them, and then they're gonna give us their house." And so they're working with us again because we have the ability to be flexible and move fast when they find something. The third one is just a family member of one of our friends who is in a need cash now type situation, and they know their property is worth more, but they just need to get out of out of the sale. And again, these people come to us because they right now because they know that we have money and they trust us.
Nice. Michael asks, he asked, do typical 30-year primary mortgages allow for HELOCs behind them? Are there instances where the loan docs would prohibit it?
Are there instances? Probably somewhere, but I've never seen it. Uh, I would imagine that that would be a non-traditional mortgage. I have a small mortgage on my property. You can get a second. It's generally more the person in the second that's concerned. Um, so they will basically lend up to like 60, 70, 80, sometimes 90% of total loan to value. So home price minus the first mortgage and then like whatever percentage that's left over after that. Did I get that right? Okay, cool. Um,
Should we ask the lenders on this call what rates they're seeing for their HELOCs?
or interesting programs.
Yeah, I mean our traditional HELOCs are prime plus a half in best case scenario. Um, I know about the Westcom deal. That's about the best I've seen. 3.99 for the first year, and then I think they're prime plus one or something like that. So those are some of the best deals that I've seen. Um,
Third,
yeah, go ahead.
third, fifth. I've heard third, fifth's pretty good, and then there's a couple online banks that I've heard of where like you can just like fill out a form and they send you an ATM card. I think the rates are a little bit higher.
They're a little higher. Yeah, I've seen some of those, like Figure and some other ones. They're pretty streamlined, but from what I've seen, those are like high nines to 10, 11-ish%. You pay for, and there's origination fees with those from what I've seen. So, yeah, like you said, just you got to kind of pencil it all out. I know all our stuff is from the appraisal to everything's free, and I think we're $50 a year or something like that at US Bank to uh to service the thing. We do also offer HE loans, which you didn't really touch on. Um, that's just if you had a certain amount of money rather than a line of credit, if you had a certain amount, like a project that you knew you needed cash for, it's a fully amortized over the length of it. So, um, but you have to pick it up front. So you have 200,000 or 100,000, whatever, and works in a similar way as far as the application, and all that, but you get all the money up front and then it's amortized. We have better rates on those. Those are usually like right at prime, sometimes a little subprime. But you need to know how much you are requesting up front and you get the full draw right away, and then it's fully amortized versus the interest only option. So, but just to piggyback off of yours, Daniel, I think it's a great tool to be able to tap into, access to your equity. Most people have, that's where their biggest investment is. That's where a lot of your capital is tied to. And so even if you don't use it, being able to, tap into it in an emergency or when opportunities come up, is a huge thing. So I'm a big fan of it. I've had one on my house. I'm actually redoing mine because my equity's gone up. I
Who's
don't have
doing
any plans
yours?
for it. What's that?
Who are you doing yours with?
Westcom, just because I know their intro rate. I did my
Yeah.
current one was with Logix, another credit union. They had a 299 intro rate, like no, it was 199 actually in 21 for the first 12 months, and then now it's at like prime plus a half or something like that. So I'm gonna refi that and get a larger line just to have access to and just let it sit there and
My
that's what I'm on the call.
my $330,000 line of credit was 980, or sorry, it was prime minus 160, which is about as aggressive as I've seen. I intentionally gave it up early to basically triple my proceeds. Um, this isn't really investment advice, but it's just like a really quick funny story. When I was redoing that line of credit, um, the lenders around here probably know the person, so I'm not going to say their name. Used to be a lender at Merrill Lynch, has now moved on somewhere else. Gave me some advice. I was getting my loan approved, and I did a cost segregation study that year, and I had a $250,000 paper loss associated with the cost segregation study, and the bank couldn't figure out for the life of them like how to get around that. And I'm like pounding my head against the table. So I called my buddy. I'm like, "What do I do? What do I do?" And um, he said, email the CEO. And I was like, "Dude, you're not being helpful here. Like, give me some real advice." He's like, "No, email the CEO. I'll text you his email address." So he texts me the email address. I email the CEO, Brian Moynihan of Bank of America. It's like 3:30 on a Friday. In an hour, get a call from a guy. "Sir, this is Mr. So and so. I'm like SVP of underwriting for Bank of America. We're gonna get this sorted out for you by Monday." It's like, what the hell? On Monday, my local guy calls and he's like, "Sir, I don't know what's going on in your file, but it's been approved." So if you're ever doing a loan with Bank of America, you're not supposed to tell anyone this, but you email the CEO if you have any problems. It's called a Moynihan escalation, and our buddy led the country in them before he was. I don't know if he asked to leave or left on his own. Melissa, who's on our team, great real estate agent covering South County for us, she just did hers with BMO. The intro rate is uh, prime minus. Is it prime minus 50 or prime minus 0.5? I think it's prime minus 50, which is really good. And then oh yeah, prime minus 50, and then uh, plus 93 thereafter. So my rate, Michael previously asked, how does my current rate compare to um, construction loans? So the bank that I use doesn't mark up on construction loans, so the rates right now are probably like low sixes, which is really solid, and that's construction permanent with no prepayment penalty. but the HELOC 7.4, and I don't have to talk to anyone to do it. So I'm the deal that we're tearing down. I don't think I'm going to get a construction loan on it. I do want to say I believe there's a 1 point origination fee on that construction to permanent loan. If I were building a house to move into, I would go with the construction to permanent loan. Yes. So Rob asked if there's a maximum on loan amounts. Yes, there is. Every bank's different. Bank of America will go up to 1 million, I think. Citizens will go up to 2 million. Um, their third, I want to say it's third, fifth, maybe. Their max is like 250. So every bank's different. It's one of those things I was talking about on the evaluating your HELOC. You want to look at the bank, not just for proceeds, or not just for interest rate, but also proceeds. If you're just starting out in your investing career and or you're younger, I would say optimize for rate up front. You're going to get in less trouble. You can optimize for proceeds as you've been through the cycle a couple of times.
Maybe another question for you guys. How do you know how much equity you have? Is it solely based on an appraisal?
Yes, unfortunately. My house appraised for I think 400,000 less than it should have, because of my relationship with the bank. They looked at the appraisal and said that's kind of silly. So that bank historically capped you out at 60%, but they took us up to 80 with no markup on it. So um, light candles and turn on some mood music when your appraiser comes and push that value. Turn on the lights. Cool.
Yeah, it's good to know. Anyone have any other questions? Feel free to put it in the chat, or you can unmute yourself as well.
I just want to touch real quick on so on the broker side of things, like people with good credit, low DTI, I feel like US Bank, they're going to be able to take care of them all day. On the broker side of things, if anybody out there needs to get a little creative, so we've got bank statement HELOCs where you don't qualify off of tax returns or W-2s. We even have CPA prepared P&L HELOCs, so your CPA can put together a P&L for your business, which is pretty neat. Typically, those were all historically just HE loans, so you had to take the bulk all at once, kind of like what Ryan was talking about. Now we actually have that in HELOC form, which is nice because it does allow investors who are getting a little creative with taxes or might have a lot of write-offs or cost segregations that they're doing where they're not necessarily being able to add it back like depreciation. We can get people qualified like that, which is pretty cool.
So John has a question that I'll defer to Elliot and Ryan, and that is, how common are appraisal waivers?
We don't, most of the time, unless you're trying to get a regular value, all of our HELOCs, whether you're qualifying for a full doc, like kind of regular HELOC, like you'd go get the bank to, most of those are going to use an automated valuation model. So AVM is basically like, going to put together what they think the property's worth. If you disagree with it, then we can do a full appraisal. Those alternative doc HELOCs are typically going to require a full appraisal.
Yeah, so really, really only necessary if you're really trying to push the limit on proceeds.
Yeah, same here. Yeah, everything's desktop appraisal. Usually, between a Redfin and a Zillow value will get you kind of ballpark of where they would be potentially. And then, yeah, just like Elliot said, if it doesn't come in, you can pay for it, a full one. Sometimes you can do just external, but obviously if there's upgrades or things that they don't know about, then you want to do a full appraisal, which $500 to $700. That would be the only cost like on our end. Otherwise, that's why it's free because they do the desktop version.
Elliot, can you do a HELOC for an investment property owned in a LLC?
Yeah, it shouldn't be a problem.
Vince, why don't you message Elliot separately and you guys can connect? Ryan, I'm guessing that's not your cup of tea.
Yep, that ain't me, man.
And is it easy to transfer your property to an LLC?
Usually title can handle that pretty easily.
Yeah. So Dominic's asking, I don't have my property under an LLC yet. I was late to the party on that. Is it easier to do it with LLC or personal? If it's your primary residence, do not do it in an LLC. That's going to complicate it. If it's an investment property, I don't imagine there's a difference. I would, Elliot, Ryan, do you guys have any thoughts on that?
Yeah, it should be fine either way.
Yeah.
Sweet. All right. Well, super good information. Hope everyone found value in that. And guys, maybe put your info again in the chat, like your email addresses, so people can reach out to you guys, especially the lenders in here. And any finishing remarks, Daniel?
No, just look, just do it and get people around you to do it. Over time, like this is one of the best ways to compound capital. It's not necessarily the easiest thing to do right now because yields are low and interest rates are high, and that's a bad a bad combination. But there's definitely opportunity out there. Yeah, this conversation is being recorded. I'm gonna send it out to everyone who expressed interest in it before. So if you don't want it, you can just delete it. But you're gonna get the email anyways. So that's it.
All right. Well,
Yeah.
appreciate everybody for.
And yeah, I just wanted to quickly mention I'm in San Diego in case anybody you're dealing with has an appetite to look at the market here. And I live with a retired builder. He cut his chops with the Irvine Company, Donald Bren, and won awards down here. So I'm well versed in the building end of things, and I'm with Keller Williams, La Jolla.
Great. Where so you're in the La Jolla area. Great.
I'm in San Diego in general.
Got it.
Uh, yeah, got to be all over the county here.
Awesome. Great.
Thank you,
Yeah,
Teresa.
sure.
All right. Thank you everyone for joining. We're gonna go ahead and end it. Great to see you all. And if you guys have separate questions or want to talk about things separately, you should have my email. It's on the or phone number. It's off to the it's on the screen. So talk to you soon. Elliot, I'll see you at the gym this week. See you guys.
Thanks, everybody. Oh, Daniel, you could even
End meeting for all.
oh yeah, I could do that.